Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500, currently trading very close to its all-time high. We've really been on an incredible run this year. In fact, the first chart that I want to show you in this video is the S&P 500 divided by the money supply. We all know that a large part of what's driving the market, especially in 2020, has been the surge in the money supply, government spending, Federal Reserve balance sheet. The expansion of monetary base goes into assets and makes these assets appreciate. That includes the S&P 500. So this is a chart of the S&P 500 divided by that money supply. And so instead of seeing a stock market that goes up over time, you now have a chart that goes sideways over time that really represents the idea behind this, that stocks go up because of the expansion in the money supply. And so looking at this chart is absolutely essential to do. This goes back to the 1990s here, and you can see the dot-com bubble, where we know that in the late 1990s, valuations were very stretched. There was excessive bullish sentiment. You had tech companies at extreme valuations between 1997 and 2000. A very interesting thing that's happening right now is that we've broken past this resistance level on this chart at around 0.2 here. This is a level that acted as resistance in 2020 here before the COVID crash. If we zoom out, we can see it acted as resistance in 2008. And during this bear market rally in 2001, acted as support here, support throughout this period. And after having had a brief rejection here, we're now breaking out above this zone of resistance and going into territory that we haven't seen since 2001 and throughout the entire dot-com bubble. So of course, there's many ways of looking at whether the stock market is in a bubble, but this is one of the things that we look at. How are stocks performing relative to the money supply? And we can see that we're getting into that part of the cycle where the stock market is getting overstretched, even when you consider the money supply expansion we've seen throughout the past couple of years. So that's what I wanted to start off with in this video, just to show you what type of environment we're in with US equities right now. Now, in this episode, we're going to be discussing what this actually means, what we can expect over the next few weeks. If you're interested in following these crazy markets with us, make sure to smash that subscribe button. And now, without further ado, let's get right into it. Now let's begin by quickly taking a look at this weekly chart of the S&P 500 and take a look at the momentum, the MACD here, a very important metric to look at. If we zoom into what's been happening over the past few weeks, you can see we had a bearish cross on the MACD here back in May 2021. This is a significant development. This is how you use the MACD. You have bearish crossovers and bullish crossovers that give you the momentum on this weekly time frame. There's a lot of investors that just use these as signals to time big market moves, right? You had a bullish crossover right here in May 2020, and that was the beginning of a major move up in the markets. You had the same thing in 2019 right here, big bullish crossover, major move up in the markets. In 2018, right here, you had a bullish crossover followed by multiple weeks of bullish price action on the markets. This indicator really speaks to the nature of the momentum that we're seeing right now for the next few months. So seeing a bullish crossover like this is definitely very interesting. It shows you that while we were perhaps in a period with a little bit less momentum between May and October 2021, we're now back in bullish momentum. The last time we had this type of development was back in 2017 here. We had a similar type of thing. You had a big move up in around 2016 here. Big bullish move. Then you have a cross down, a bearish cross with a period of slower momentum, slowing economic growth throughout the summer. This was May, June, July, and August, right? Where you often have a little bit of slower economic growth, slower stock market returns. And then you have that bullish crossover that triggers a multi-week, multi-month move up in the markets. Perhaps we're in a similar type of situation right now with a mid-cycle renewal of momentum like this. Now, in the shorter term, we have discussed that we're seeing signs of a little bit of overextension in the markets. This is not a particularly favorable entry point if you want to take advantage of this move, right? We're at resistance, we're overbought on this RSI, often corresponding to short-term periods of consolidation, right? When you have an overbought RSI reading, you tend to see a little bit of a sideways consolidation. Happened here in April 2021 again. So we'll see what happens in the short term. But considering the weekly momentum that we have here, this is just such strong price action that I don't think we'll see a large pullback. It's likely to be shallow, and we're likely to see a lot of buyers step in very quickly. We recently had a very strong non-farm payroll report that beat expectations. Same thing with the unemployment rate, beat expectations. We have S&P 500 profit margins that are pointing straight up, and we have the number of businesses reporting poor sales at an extreme low here, which often represents very strong economic conditions. So the intermediate term outlook for the S&P 500 right now is just beautiful. It's very important to keep in mind that broader perspective on the market. By the way, if you like the information, the research, and the analysis that we provide, don't forget to click on that like button. It really helps us grow our channel, pushes out these videos to more people, and makes all of our efforts worthwhile. So thank you very much for doing that. So now, except for perhaps some short-term volatility, we expect the markets to perform extremely well over the next few months, which is very likely to push this S&P 500 to money supply ratio into bubble territory and revisit highs that we haven't seen since the 1990s. And the same thing goes for typical valuation metrics like the market cap to GDP, also known as the Buffett indicator, right, which actually gives you a measure of what the stock market total market cap is relative to the economic output. It would make sense to see the total market cap be more or less equal to our economic output. If that's not the case, then the businesses that you're buying in the Wilshire 5000 are too expensive. And you can see this indicator right now is going above 200% here, well into bubble territory. So if we see further outperformance in the next few months, we'll see these metrics go absolutely off the charts. We'll see the stock market go into hyper-valuations. And this is exactly why we believe that this is going to be one of the last big bull runs on the S&P 500 for a very long time. I mean, if you take a look at the 10-year annualized returns of the S&P 500, we were already getting into the upper end of the range back in 2018. This is a chart from around mid-2020. We're a lot higher than this right now, and we're definitely going to be in the upper end of that range if we have another big rally on the S&P 500 throughout the next few months. Now, if you take a look at one of the biggest drivers of the S&P 500 throughout the past 40 years, it's the 10-year yield, right? This is the 10-year yield on government bonds. And you can see since 1981, we've had the 10-year yield come down. So the yield that you get on your bond has been coming down steadily throughout the past 40 years. So it makes sense that investors, big capital, tend to have gravitated away from bonds and into higher return assets like the stock market. If you take a look at the S&P 500 versus the bond yield, you can see that since 1982 here, we've had tremendous S&P 500 performance because of those falling bond yields. That really starts to paint a bearish case for the S&P 500 longer term because the bond yield is now at 1.5%. So the entire run-up that we've seen throughout the past 4 decades on the S&P 500 that's been fueled by falling bond yields, you can't make the case for that anymore because bond yields can only go so much lower. In fact, if you take a look at what was happening to the S&P 500 when bond yields were rising throughout the 1960s and 70s, the stock market went absolutely nowhere throughout that entire period of time. So we're really going to see an environment where it's going to be incredibly difficult to yield the same returns that we've had over the past 40 years. And on top of that, you're going to see massive devaluation of currency because of inflation, because government spending is going to get out of control throughout the next few years. That's almost inevitable. So stocks are going to be a very bad option to hold. Bonds are going to be a very bad option to hold. Cash is going to be an incredibly bad option to hold. So this is going to absolutely, completely change the investing and macroeconomic landscape. Now on gameoftrades.net with our team, we've worked through and identified the best assets, the assets that we think are going to be big outperformers throughout the next decade and are going to be protected from this shift in the macroeconomic environment. So if you want to come on our platform and learn what these assets are, the reasons why, how to navigate through these assets successfully, and how to actually take advantage of each of these opportunities, I think there's going to be some absolutely massive opportunities here throughout the next 5 to 10 years, whether that's in precious metals, whether that's in cryptocurrencies, commodities, the energy sector, emerging markets. We fully intend on working with our members to help them protect themselves from this environment and to take advantage of future opportunities. So again, make sure to check out our website at gameoftrades.net. You can test out our free trial to take a look at some of our recent articles. We recently posted an article on Tesla that was showing quite a few signs of overextension and greed. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button. Now in the meantime, I wish you good luck on your trading and see you next time.